Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Brian Stutland, Chief Investment Officer over Equity Armor Investments, to discuss Nasdaq-100 Volatility Index, or what we call Vol-Q, some of the trends that we're seeing there. Brian, it's great to see you. Welcome back to Trade Talks.
Thanks for having me.
And it's so interesting whether we're looking at Vol-Q or the VIX, Brian. I think, particularly over the past couple of weeks, is the velocity of the moves from 1%, 2% down, up. I mean, you could start the session down and up at the end of the day. It's really the velocity and the amount of the moves that we're seeing. Yeah,
it does seem like it's increasing ever more every day that passes. And I mean, it makes sense, right? If the Federal Reserve is going to sort of ease off the gas on printing money and actually stop doing that and raise interest rates in the back half of this year, then, I do expect some of this velocity to continue and some of the volatility continue. And when you look at Vol-Q or the VIX and some of these volatility indexes, they keep making higher highs, especially recently. The move, Vol came down for the first day of the year, but since then, we've had a ton of volatility. That trend continues to the upside, and I kind of see that happening for the next foreseeable future.
And Brian, you were mentioning in your note that, we're at that key level of 1.7% on the 10-year. And if we continue to get these interest rate hikes throughout the year, you could think that it could go to 3% by the end of the year. That's kind of a big move when you look at the 10-year.
It certainly is. And I think that 170 really was a key level for the 10-year note. And I think right now we're on the path. We sort of came back down, back to 170. Sort of tested that support. Now we see the 10-year back up at 176 today, trading today. So it looks like interest rates want to move higher, at least the back end of the curve here. And so if that happens, my one concern really is that happens in a slow way. If it happens fast, like we've seen the start of this year, we saw the 10-year note go from 150 to 176 now in the matter of a week or two. If that continues to happen and that march happens all the way to 3%, like I talked about, that I think can happen, but it happens fast, there's going to be a ton of volatility in this marketplace.
Well, I mean, that's going to impact liquidity as well.
It certainly will. And so, if the Federal Reserve is going to stop buying bonds, who's left then to buy the bonds? Because they've been the backstop to all of this. And so it's going to make really for an interesting market sort of the second half of this year.
So, Brian, if we're not buying bonds here and we have to think about diversification, how are you managing a portfolio then?
Yeah, I think that's a great question because we are starting to pull back a little bit on our bond exposure for clients. And so one thing that we are adding is I think owning volatility. I know I'm sort of kind of talking in my book because obviously we manage a fund that buys the Nasdaq, it buys VIX futures together. But really, I think that's the trade going forward because now at least I have some sort of diversified asset class that if the stock market starts to sell off or continues to do so, typically what we do see is volatility pick up and the VIX or Vol-Q and stuff like that, those items start to rise in value. So I'm trying to mix volatility with stocks, and I think that's going to be the play for 2022.
All right, Brian, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks.